Let's get more on the markets. We're welcoming David Aspell, Co-Chief Investment Officer at Mount Lucas Management. David, thanks very much for coming on the show.
Thanks for having me.
We're going to get into a technique you favor later, manage futures. But broadly, can we just talk about the equity markets right now? The equity markets aren't cheap. Give us your take there. I mean, they're at or near record highs.
They are, yeah. They're very close to record highs currently. Earnings have been excellent, though, generally. I think that we've just gone through an earnings season that's been very good. I think you're seeing the market is starting to price in the falling dollar as good for equity earnings, which is right. And it's definitely starting to sniff out some of the lower rates that I think people are expecting, which are again helps to boost some of the interest rate sensitive sectors of the economy, which can certainly help those areas in earnings. And the AI trade, that seems like just a structural shift where those companies are they're just excellent businesses, and they're just continuing to motor along.
Is this enough? Weakness in the labor market, is it enough to induce the Fed to cut at its meeting next month?
I think if there's further weakness in the labor market, you're going to be looking at a 50 basis points cut. Yeah, I would say, I mean, there's another round of data that comes in before the September meeting, and the bond yields are moving as the Fed we've got the Jackson Hole meeting this week. There's incoming data. There's another round of it. It's juggling poor payrolls and the revisions with this idea that we might have stickier inflation. I think that the jobs number last month with the revisions is enough. For me, I would have thought that a 50 basis point cut seems more than reasonable. But we do get another round of data, so we'll find out.
What a dilemma for his lordship, Jay Powell at the Fed. I mean, it seems a given. He's once his term is up, he won't be chairman anymore.
Yeah, I would have thought so. I mean, I think he could stay on, but I think that's pretty unlikely. I guess it would depend on who it was that replaces him. If it's Waller, I would imagine he would certainly leave. But I would imagine he would see his term out and leave. There's a lot of pressure on him. But I know the administration is trying to pressure him a lot to cut rates by 150 or 200 basis points. But it is a committee. There's staggered appointments. Yeah. I think generally they're doing their best under very difficult circumstances. They are in a tough spot. Mm-hmm. We've just gone through a period of bruising inflation, and they want to make sure it's done. I think if you just look at what's going on in the housing market, I think it's pretty clear to me, at least, that overall there's enough room for them to cut rates.
Give us your take on commodities. What about gold, a beloved subject for our viewers? It has come down from those record highs of a few weeks ago. Do you think there's upside here? Presumably a lower US dollar and lower interest rates are good for bullion.
You would think, yeah. I mean, it's gone sideways for coming on 6 months now, but it's been in a fantastic uptrend for the past few years. We do manage future strategies. We get exposure to this. We do long and short. So we've been long gold for quite some time. And you're right, some amount of it is a weakness in the dollar as well. It's kind of the reverse of the dollar trade. I think the only thing that gives me some pause is, if you do get a set of, I guess, peaceful outcomes in some of the, with Russia and Ukraine. And one of the drivers you've seen from gold over the past few years, I think, has been countries trying to get assets out of the reach of the US sanctions. And gold is one of those places. The US Treasury, once it starts, if it wants to start sanctioning you and seizing assets, it's very powerful and can do so. And gold is one of those assets that can benefit from those type of flows. So if you see something of a truce or just a toning down of those things, I could see some of the reasons being long gold to come out. I mean, I guess that's possible too, but broadly, I think the drivers are in place for it.
We're tight for time. You are an advocate of managed futures. You say they offer a tool that investors can't readily, or offer strategies that would be tough for smaller investors. Tell us what's involved in managed futures.
Yeah, so managed futures, it's been around a really long time. What it does, it picks up a different set of risk premium than you get in the equity markets. It gives investors direct exposures to different things. And particularly one thing I think is real valuable is it gives exposure both on the long side and the short side. There's not very many places where investors can go to get exposure to bond yields going up. You get that in managed futures by being short of the bond market. There's not that many places investors can go to get direct exposure to commodities. And those are often the areas that are hurting equity markets in 2022. You think commodity prices going up and bond prices going down was exactly the thing that was hurting the equity multiple. Having managed futures in portfolios gives direct exposure to those things. And it's just a great diversification tool we found.
Thank you very much indeed for joining us.